Imagine generating like a massive 14% leap in revenue.
Right.
You release those numbers to the public, you watch the market applaud, and then you look under the hood and realize your actual underlying core business grew by just 2%.
Yeah, it's a completely different story.
Exactly. So today, we're dissecting what looks like a financial illusion. We're looking at McCormick Company, ticker symbol MKC.
The Spice Guys.
Right, the Spice Guys. But, they are so much more than that now. For this deep dive, we've cross-referenced their Q2 2026 earnings call with, a ton of historical analyst models, supply chain data, and management's past recession playbooks.
Yeah, to figure out what's actually happening behind the curtain.
Exactly. Because our mission today is to cut through all that corporate messaging, isolate the actual signal from the noise, and, give you the actionable data you need to decide if this stock actually belongs in your portfolio right now.
Because McCormick isn't just the paprika sitting in the back of your pantry anymore. It's a global flavor powerhouse at this point.
It really is.
Yeah.
But with inflation just absolutely squeezing the consumer right now, the big question is this stock a spicy buy or is it, losing its flavor?
I love that. But yeah, the headline numbers management presented right at the top of the call, they look like a victory lap.
Oh, totally.
Especially in a macroeconomic environment that has just been punishing to food companies lately.
Brutal. It's been brutal for them.
Right. So let's lay out the raw data first. They posted total net sales growth of 14% in constant currency.
Which is huge.
Massive. And adjusted earnings per share, the EPS, it hit 80 cents. So that's a 16% year-over-year increase.
Wow, okay.
Yeah, and adjusted operating income jumped a massive 30%.
30%? That's kind of wild for a legacy brand.
It is. And then the metric that really turns heads on Wall Street, right? Gross profit margin expanded by an incredible 270 basis points.
Okay, wait, hold on. Because I got to jump in here. Those numbers, they feel entirely disconnected from the reality of the consumer that we're seeing in all the other macroeconomic data.
Oh, 100%.
Like a 14% top line jump in a mature legacy food brand market.
Yeah.
It basically suggests they somehow invented a spice that makes people immune to inflation.
Right, like a magic anti-inflation seasoning.
Exactly. But diving into the balance sheet, the story kind of collapses, doesn't it?
It completely collapses because you have to translate the jargon.
Right, so let's unpack this. Didn't they just buy a massive chunk of that growth?
Yes, they absolutely did. A staggering 12% of that massive 14% revenue jump came purely from inorganic growth.
Okay, so acquisitions.
Precisely. Specifically, the acquisition of McCormick to Mexico. They effectively just bought that headline number.
So if we strip away the makeup, what's left?
If you look at the organic sales growth, which is, the actual measure of how their existing underlying business is performing.
Right, what they actually sold organically.
Yeah, actually, it was a microscopic 2%.
Wow. Okay, 2% organic. That is a radically different reality than 14%.
It really is. And, buying growth is a classic lever to pull when your core engine is sputtering out.
For sure. But isn't there a catch there?
A huge catch. It permanently alters the risk profile for investors.
Yeah.
You can't just perpetually acquire regional players to, mask a stagnant legacy portfolio.
Especially not when you're financing those acquisitions in a higher rate environment, right? Money isn't free anymore.
Exactly. The market initially reacts to the consolidated top line, the big 14%. But the multiples eventually contract if that organic foundation is crumbling.
Yeah, you can't fake it forever.
Right. And that same distortion is heavily skewing those margin numbers you mentioned earlier, too.
The 270 basis points.
Yeah. A 270 basis point expansion in gross profit margin in the food sector is monumental.
It's unheard of right now.
But a forensic look at the cash flow statement reveals a massive artificial tailwind there, too.
Okay, yeah. The CFO, Marcos Gabriel, he kind of buried the lead on this during the prepared remarks, didn't he?
Oh, completely buried it.
Because over half of that margin expansion, 140 basis points of it, came from a one-time $28 million tariff refund.
Yep. Just a one-time check from the government.
Right. They had been absorbing these 10% global tariffs in prior periods, taking the hit on their own profitability.
They hurt their margins back then.
Exactly. So now the government cuts them a check for the refund. That $28 million hits the income statement all at once in Q2, and suddenly the gross margins magically look bulletproof.
It's accounting magic.
So if you strip out the Mexican acquisition and you strip out the government tariff refund, this blockbuster quarter suddenly looks, well, incredibly vulnerable.
Very vulnerable. Now, to be fair, taking out that tariff refund still leaves an underlying gross margin expansion of 130 basis points.
Okay, so that's real.
That part is real, yeah. And that underlying figure is actually a pretty solid testament to their comprehensive continuous improvement program.
The CCI initiatives they talk about.
Right. They are actively stripping out manufacturing inefficiencies. They're renegotiating packaging contracts. They are doing the hard operational work.
But 130 basis points of operational efficiency, I mean, it still can't hide the fact that a 2% organic growth rate means the underlying business is losing momentum.
Exactly. You can only cut costs so much. Eventually, you have to sell more stuff.
Right. So the tension in this entire earnings call lies entirely in understanding why that core engine is slowing down.
Right, because 14% headline growth looks great on CNBC, but the organic reality tells a way more complicated story.
It does. And that brings us to, the fundamental tug of war ripping through McCormick's balance sheet right now. To understand why that organic growth is stuck at 2%, we have to split the company into its two distinct identities.
Because they really are two different companies functioning under one roof.
Yeah. First, there's the global consumer segment.
Yeah.
You know, the retail spices lining the grocery store aisles that we all buy.
The stuff in everyone's pantry.
Right. And second, there's the global flavor solutions segment, which is their B2B operation selling directly to CPGs, consumer packaged goods companies, and restaurant chains.
And those two segments are moving in completely opposite directions right now. Let's start with the bear case.
Okay, lay it on me.
The consumer side is flashing deep, deep red warning signs. In the Americas, which is the absolute most critical geography for their consumer portfolio.
The bread and butter.
Exactly. In the Americas, consumer organic sales were completely flat. Zero growth.
Wow.
And the mechanics behind that flat line are just brutal. They push pricing up 3%, right?
Okay, so things got 3% more expensive.
Right, and the consumer retaliated by dropping their purchasing volume by exactly 3%.
Oh, wow. So it totally wiped it out.
A one-for-one wipeout.
Man. There was a great phrase used by an analyst on the call, Peter Galbo from Bank of America. He described this consumer environment as macro whack-a-mole.
Yes, that was the perfect way to frame it.
Because inflation isn't just a single event, right? It's a compounding series of shocks. A shopper absorbs a spike in housing costs, then gasoline surges, then protein prices jump.
Eggs go through the roof.
Exactly. And by the time that consumer finally reaches the spice aisle, they are operating in a state of severe budget preservation.
They're just tapped out. And CEO Brendan Foley, he openly acknowledged this on the call. He said that geopolitical volatility and elevated fuel costs are fundamentally altering how people shop right now.
They're becoming hyper-selective.
Very. They're actively managing their total basket size. They are scrutinizing every single item for its utility to cost ratio. Do I really need this?
Right. And the unit economics of the grocery cart right now, they are working against legacy brands like McCormick.
Big time. Because think about it. If a shopper needs garlic powder, the branded McCormick bottle might command $5.
Yeah. And the store's private label sits literally inches away for $2.50.
Half the price.
Right. Now, in a zero interest rate environment, when money is flowing, the consumer might just default to the premium brand out of habit, right? Or perceived quality.
Sure, you don't even look at the price tag.
Exactly. But today, a 100% price premium for a highly commoditized ingredient like garlic powder, it is impossible to justify for a cash-strapped family.
It really is. And because of that, the legacy workhorses of McCormick's portfolio, specific brands like Grill Mates and Larry's.
Oh, yeah, the classics.
Right. They are suffering severe market share erosion right now. They're actively losing ground to emerging brands and private labels.
Because the price gaps between the premium tier and that private label tier have just widened way past the breaking point.
Right. The premium just isn't worth it anymore for a lot of people. And compounding that private label threat is another behavioral shift that Foley referred to. He called it pantry utilization.
Oh, pantry utilization. This is fascinating.
It is the ultimate headwind for a company selling shelf-stable products. Because think about it, spices do not spoil like dairy or produce, right? They degrade very, very slowly over years.
Yeah, I think I have spices from 3 apartments ago.
We all do. And when macroeconomic pressure peaks, the spice aisle becomes entirely discretionary. Consumers simply dig into the back of their cabinets and use the 3-year-old cumin they completely forgot they had.
Right, instead of buying a fresh bottle.
Exactly. And this creates an immediate velocity problem at retail.
Because the bottles just sit on the shelf.
Right.
Yeah.
The retailer sees the McCormick products moving slower, gathering dust. And that jeopardizes future shelf space negotiations and promotional placements for McCormick down the line.
Because Walmart or Kroger will just be like, hey, your stuff isn't moving. We're giving this end cap to our store brand.
Exactly. It's a vicious cycle.
So that volume destruction on the consumer side, I mean, that would normally crater a stock completely. But McCormick was entirely bailed out by their business-to-business arm, weren't they?
They absolutely were. This is the bull case. The global flavor solutions segment is operating in a completely different reality than the grocery store consumer.
Okay, let's hear the numbers on the B2B side.
Constant currency sales for flavor solutions grew by 6%.
Okay, solid.
And organic growth hit 3%. But more importantly, that organic growth was balanced. It was driven equally by volume increases and price increases.
Not like the consumer side where price hikes just killed volume.
Exactly. It was healthy growth. And in the Americas specifically, this B2B segment posted a very aggressive 4% organic jump.
Okay, so that divergence is crazy. The retail consumer is retreating, but the B2B segment is thriving. What is driving that?
It highlights a massive structural shift happening in the food industry right now. So McCormick supplies the foundational flavor architecture for massive CPG corporations and quick service restaurants.
Like fast food and packaged snacks.
Right. And the overarching mandate for all these CPGs right now is health and wellness. Every major food conglomerate is racing to reformulate their portfolios.
Oh, like higher protein snacks, zero sugar drinks, functional hydration.
Plant-based alternatives, exactly. And the open secret in food science is that functional ingredients usually taste terrible on their own.
Yeah, they really do.
I mean, pea protein isolate. It has an earthy, chalky profile. It's gross.
It's like eating drywall.
Right. And stevia carries this metallic, bitter aftertaste. So when a CPG company designs a highly nutritious, low-sugar protein bar, the baseline product is virtually inedible.
So what do?
They issue what the industry calls an innovation brief to McCormick. They basically hand over this bitter, chalky prototype and demand, make this taste like a salted caramel brownie.
And McCormick can actually do that.
They can. McCormick utilizes its 4 core taste competencies: savory, heat, naturally sweet, and citrus. They use these to chemically mask the off notes and build a synthetic but natural tasting flavor profile right on top of that functional base.
Oh, wow. So McCormick acts as this critical bridge between the nutritional science and actual consumer palatability. If it doesn't taste good, no one buys the healthy snack.
Exactly. And Foley noted that a significant majority of the customer briefs they won in the second quarter were directly tied to health, wellness, and reformulation.
So they are winning these contracts left and right.
Their win rate on these highly technical briefs is accelerating rapidly. They are essentially the picks and shovels play for the health food gold rush.
Oh, I like that analogy.
Because as an investor, you don't need to predict which startup energy drink or plant-based snack is going to dominate the market. You can simply own the company engineering the flavor systems for all of them.
Right, whether brand A or brand B wins the protein bar wars, McCormick still gets paid because they supplied the flavor for both.
Exactly. And that dominance in the B2B space is also spilling over into their branded food service.
You mean like restaurants?
Yeah. Think about those little packets of Frank's Red Hot or Cholula sitting on restaurant tables. They saw significant volume and sales growth this quarter.
Oh, that's interesting.
They are aggressively capturing these front-of-house placements, which serves a dual purpose. First, it generates immediate B2B revenue. But second, it acts as free, high-visibility marketing to the consumer.
Right, because you use it at the restaurant, you like it, and then you might go buy a full bottle at the grocery store later.
Exactly. It's brilliant marketing. But look, even with Flavor Solutions just printing cash right now, the macroeconomic environment is still attacking their supply chain.
Right, it's not all sunshine and rainbows. Let's talk about the cost pressures.
Yeah, that $28 million tariff refund we talked about, the one making their margins look so good.
Yeah.
It's going to be vaporized almost instantly by a massive surge in global logistics costs.
Oh boy. Okay, what's going on there?
CFO Marcos Gabriel provided a really sobering look at their freight dynamics. The ongoing conflict in the Middle East has severely disrupted the Red Sea shipping lanes.
Right, we've seen this in the news. Commercial vessels are rerouting.
They are rerouting all the way around the Cape of Good Hope down in Africa, and that adds thousands of nautical miles and literally weeks of transit time to every single shipment.
Which burns dramatically more bunker fuel, it ties up container capacity, and it sends spot freight rates just skyrocketing.
Exactly. And McCormick's supply chain is heavily dependent on raw agricultural imports.
Like what?
Vanilla from Madagascar, cinnamon from Indonesia, pepper from Vietnam. They are acutely exposed to these oceanic freight shocks because their stuff has to cross the world.
And I imagine agricultural commodities are often locked into long-term contracts, right? So the price of the pepper might be fixed.
Right, but the freight to move those commodities is subject to the spot market volatility. The boats cost more.
Got it.
So Gabriel warned that these geopolitical tensions are pushing their internal inflation models toward the absolute high end of their guidance, which is around 6% inflation.
That's a huge hit.
It is. So they are not banking that $28 million tariff refund to boost the bottom line for shareholders. They are deploying it as an emergency shock absorber to neutralize these catastrophic freight spikes.
Wow. So it's basically an exercise in treading water just to maintain the illusion of margin stability.
Exactly. They aren't getting ahead. They're just trying not to drown in freight costs.
Okay, so recapping this, the B2B flavor business is thriving. But the grocery store consumer is retreating, and global shipping costs are eating their lunch.
Yep, that's the setup.
The ultimate question for investors then is, how does management plan to fix the consumer side, and what does the rest of the year look like? Because they can't rely on B2B to infinitely subsidize the retail business, right?
No, they can't, and management knows that. So they outlined a highly specific, capital-intensive turnaround playbook aimed squarely at resuscitating that global consumer segment.
And this isn't just theoretical, right? I read they deployed a similar strategy like 2 years ago during a previous inflationary spike.
They did, and it worked. And the foundational pillar of this turnaround playbook is something called optimized price pack architecture.
Okay, price pack architecture, or PPA. This is a fascinating psychological game played on the grocery store shelf.
It really is. Break it down for us.
So when a consumer hits a price ceiling, let's say they absolutely refuse to pay $6 for a standard jar of basil. A legacy brand really only has two choices.
Right.
Choice one, they can slash the price to $4. But that permanently degrades their profit margin, and it trains the consumer to always wait for discounts.
Which is a death spiral for a premium brand. You never want to train the customer that your product is cheap.
Exactly. So choice two, they can introduce a smaller entry-level jar for $3.
Shrinkflation, essentially, but positioned as an entry point.
Basically. PPA preserves the margin structure while lowering the absolute barrier to entry. The consumer feels like they're making a budget-conscious choice because they're only spending $3, and McCormick prevents that shopper from defecting to the $2 private label alternative.
It keeps them in the McCormick ecosystem.
Exactly. But the unit economics of PPA are incredibly complex, aren't they?
Oh, very, because shrinking the physical product often actually increases the packaging cost as a percentage of goods sold.
Because you need more jars.
Right. You are using more glass, more plastic, and more label material per ounce of actual spice inside the bottle.
That makes sense.
So to maintain margins on a smaller footprint, the company relies heavily on those continuous improvement programs we discussed earlier, the CCI stuff.
Right, optimizing the manufacturing line to handle the new, smaller form factors without jacking up overhead costs.
Exactly. Furthermore, retailers like Walmart and Kroger guard their shelf space fiercely.
Oh yeah, every inch is calculated.
So convincing a retailer to stock 3 different sizes of the same exact CIU requires McCormick to prove that this new architecture will drive higher overall velocity and category growth for the store.
Like trust us, giving us more shelf space for smaller bottles will actually make you more money.
Right. And driving that shelf velocity requires massive demand generation. Which brings us to the second and third pillars of management's playbook: precision digital marketing and culturally relevant brand tie-ins.
Okay, I love this part. So Foley highlighted a pivot away from broad, generic television advertising, right?
Yeah. No more expensive Super Bowl ads for just general spices.
They're moving toward highly targeted, occasion-based digital marketing.
What does that mean in practice?
It means they're using data to serve specific recipe ideas to targeted demographics, precisely when they're planning their weekly grocery trips, like showing you a taco recipe on Thursday afternoon or right before you go shopping for the weekend.
Oh, that's smart.
But the most aggressive move is how they are repositioning premium spices as lifestyle accessories.
Right, moving from a commodity ingredient to a lifestyle brand. And it's super evident in their recent partnership slate.
Give us some examples, because these are wild.
Okay, so they formulated a bright green French's mustard using natural colors, specifically to tie into the release of the new Minions movie.
Green mustard? That sounds completely like a gimmick.
It does sound like a gimmick, but it actually serves a very precise strategic function. It creates immediate, disruptive visual interest in an otherwise completely static condiment aisle.
Right. Yellow, yellow, red, red, green.
Exactly. You stop and look at it, and it drives impulse purchases from households with kids that wouldn't normally need to replenish their mustard supply for another month.
Wow. Okay, that is smart.
And more importantly, they are aggressively pushing their high-margin finishing sugars and salts by tying them to massive cultural franchises.
Right. I saw they did stuff with Bridgerton, Harry Potter, and even Paris Hilton. Paris Hilton finishing salt.
Yes. Ingredient they want to be seen as an affordable indulgence.
Affordable indulgence.
Yeah.
We will definitely dig into the macroeconomic implications of that specific phrase at the end of the show, because I think it is the most important psychological insight of the entire earnings call.
It really is.
But looking at the near term, executing this massive marketing blitz and overhauling all this packaging architecture requires a ton of capital.
A ton of it.
And that is going to create severe turbulence in the upcoming third quarter, isn't it?
Yes. Buckle up for Q3. Management did reiterate their full-year guidance. They still expect full-year gross margins to expand by 100 to 120 basis points overall.
Okay, so the full year looks okay.
Yes, but Q3 is going to be an absolute gauntlet for the bottom line. Max Gumpart from BNP Paribas, he's an analyst, he correctly identified a massive sequential deceleration in the Q3 guidance.
Okay, let's translate the jargon here. Why is Q3 going to look so bad?
So CFO Marcos Gabriel explained that while adjusted operating income will likely grow in the high single to low double digits, which is good, the actual earnings per share, the profit, will drop noticeably.
Okay, that disconnect is weird. Income goes up, but earnings per share drops.
Yes. And it's driven by two immense non-operational headwinds hitting them simultaneously in Q3.
Okay, what's the first one?
The first is a pure tax normalization. Basically, in Q3 of last year, McCormick booked an artificially low tax rate of roughly 16%.
Okay.
This year, they are reverting to a normalized tax rate of 24%.
Whoa. That is an 800 basis point swing in the tax rate.
Yeah.
That is going to automatically depress their EPS, regardless of how many bottles of hot sauce they sell.
Exactly. It's just a math problem on the balance sheet. And Wall Street algorithms that purely scrape headline earnings will likely trigger automated sell-offs based on that EPS drop.
Right. The computers will just see EPS down and hit sell.
Exactly. It creates noise that human investors need to look past.
Okay, so that's the tax issue. What is the second factor dragging down Q3?
The second factor is entirely self-inflicted. They are deliberately front-loading a massive surge of SG&A expenses.
SG&A, so sales, general, and administrative expenses.
Right. They are essentially taking the car to the mechanic for a brand new transmission right after getting hit with a massive tax bill. It drains the checking account in the short term, but it is the only way the vehicle runs properly in the fourth quarter.
Okay, so what's the transmission in this analogy? What are they spending all this money on?
It's a comprehensive ERP system implementation.
Oh, wow.
Yeah. Upgrading an enterprise resource planning system, the central nervous system that dictates global inventory, accounting, and supply chain logistics, it is notoriously disruptive and incredibly capital intensive.
Yeah, those tech upgrades can be a nightmare.
They are expensing a significant portion of this massive technology upgrade all in Q3, and simultaneously, they are fully funding employee incentive compensation programs that they had previously cut back on.
Got to pay the talent.
Right. Plus, they are writing all the massive checks for those Bridgerton and Minions marketing campaigns we just talked about.
So they're just eating all the costs right now.
They are absorbing maximum financial pain in Q3 with a very specific stated objective: force consumer volumes back into positive territory by Q4.
Wow. Foley has explicitly painted management into a corner here, hasn't he?
Completely.
Because they have promised the market that this front-loaded investment will result in sequential volume improvement throughout Q3. culminating in actual positive volume growth by the end of the year.
Right. And if they fail to deliver that Q4 inflection point...
Oh, the market will realize they burned millions of dollars on marketing and packaging without actually moving the needle.
Exactly. The turnaround will look like a failure.
So the stakes for the back half of the year are incredibly high. And this is all happening while they're attempting to digest one of the most complex acquisitions in their history.
Oh, right. The elephant in the room, the Unilever Foods deal.
Let's talk about that, because the pending acquisition of the Unilever Foods division is just this massive structural overhang on this entire narrative.
It was announced on March 31st, right?
Right. And this is a transformative transaction that forces McCormick to integrate a massive global portfolio while simultaneously fighting a domestic turnaround.
That is a lot to juggle. Management revealed they have dedicated over 200 personnel operating across 20 distinct functional teams solely to map out the integration process.
200 people just for the integration.
Yeah. The sheer bandwidth required to extract a massive division from a parent conglomerate like Unilever introduces severe execution risk.
How are they trying to mitigate that risk?
To mitigate it, McCormick is relying heavily on transition services agreements, or TSAs.
Okay, explain TSAs for us.
Basically, they are paying Unilever to continue running the backbone of the acquired business for them.
So Unilever still runs the IT systems, the distribution networks, the back office HR.
Right, for up to 2 years post-close. A TSA prevents total operational collapse on day one because you aren't trying to switch systems overnight.
But there's a cost, right?
A huge cost. It acts as a massive margin anchor. You are essentially paying premium rent on someone else's infrastructure while simultaneously spending your own capital to build your replacement infrastructure.
Oh, that hurts. And then what happens when the TSA expires?
That's the scary part. Once the TSA expires, you have to execute a hard cutover of all digital and physical assets. And that is historically where M&A integrations fail most spectacularly.
Like systems crash, orders get lost, chaos ensues.
Exactly.
But despite the known risks of TSAs and complex integrations, management is projecting an incredibly aggressive financial profile for this deal, aren't they?
Extremely aggressive. They are forecasting 21% operating margins at close.
21%.
Yeah. And Alexia Howard from Bernstein aggressively challenged this projection during the Q&A. She pointed out that 21% is a total anomaly in the food CPG sector.
Yeah, operators are usually thrilled just to break 15%.
Right. So the immediate suspicion when management models margins that high is that they are gutting the acquired brands.
Like slashing R&D, halting marketing, and basically starving the product to artificially inflate the short-term financials.
Just squeezing it for cash.
But Foley and Gabriel pushed back really hard on that narrative, didn't they?
They did. They insisted the 21% margin is organic to the acquired portfolio's current structure. It's not a result of slash and burn cost cutting.
They even committed to maintaining a 7 to 8% marketing spend as a percentage of sales on the Unilever brands.
Which is a highly competitive, industry-leading reinvestment rate. You don't spend 8% on marketing if you're trying to gut the brand.
So where does the 21% come from, then?
They attribute the lofty operating margin to the underlying gross margin superiority of the products themselves and the exceptional working capital dynamics of the division.
Okay, talk to me about the working capital.
Gabriel highlighted that the Unilever Foods business boasts a working capital structure that allows for nearly 100% free cash flow conversion from net income.
Wow. Completely independent of any future cost synergies.
Exactly. McCormick is basically acquiring a highly optimized cash generation engine.
And that cash is vital because it immediately fuels their aggressive deleveraging strategy.
Right, because they took on debt to do this.
Even after the McCormick de Mexico acquisition, they have maintained a leverage ratio of 2.9 times. But management anticipates generating enough free cash flow to pay down $1.5 to $2 billion of debt within the first 24 months after the Unilever deal closes.
That's a massive deleveraging schedule, but it makes sense. They have built a reputation on Wall Street as exceptional capital allocators.
They really have. They lever up to acquire premium assets. They squeeze massive cash flows out of the combined entity. They rapidly pay down the debt to protect their investment grade rating, and then they reload for the next cycle.
It's a proven machine, and the $431 million in operating cash flow they generated in just the first half of this year.
Which is up dramatically from $161 million last year, by the way.
Huge jump. It proves the core machine is highly liquid.
But as we always say on Talk Tickers, cash flow from legacy operations and B2B strength doesn't negate the immediate actionable risks facing retail investors today. So we've looked at the headline beats, the underlying segment struggles, the heavy investments coming in Q3, and the massive Unilever integration. Let's distill all of this into a definitive bottom line. What does this mean for someone holding or considering the stock?
Looking at the totality of the data, the artificial headline beats from acquisitions and tariffs, the volume destruction in consumer retail, the explosive growth in flavor solutions, and the upcoming Q3 margin contraction, the definitive verdict on McCormick for the retail investor is a cautious hold.
A cautious hold, I agree. The macro environment is simply too volatile right now, and the company is navigating way too many simultaneous transitions to justify initiating a brand new position at current valuations.
It's just too risky to jump in blind today.
Exactly. But let's look at the bull rationale first. If you already hold NKC in your portfolio, panic selling now just ignores the structural fortresses they have built.
Right. The bull rationale for holding is heavily rooted in their capital return and their B2B dominance.
Yeah, I mean, they distributed $258 million in dividends in the first half of the year alone.
They pay you to wait. And where leverage is under control at 2.9x, and the Unilever acquisition brings that massive influx of free cash flow we just talked about.
Plus, the global flavor solutions segment proves they are highly relevant. It essentially guarantees McCormick a seat at the table for the next decade of food innovation.
Absolutely. As long as CPGs are struggling to make zero-sugar, high-protein foods palatable, McCormick possesses the proprietary flavor chemistry required to solve those exact problems.
So the B2B business provides an incredibly strong floor for the stock.
It does. However, the bare rationale for investors looking to buy right now is equally compelling.
Yeah, if you are looking to buy, you might want to wait. The historical core of this company, the premium consumer spice aisle, is actively losing its defensive mode.
Losing ground fast. Flat organic sales and negative 3% volume growth in the Americas prove that the modern consumer has broken their brand loyalty.
Yep. When purchasing power contracts, consumers readily substitute Grill Mates for the cheaper store brand. And reversing that behavioral shift is notoriously difficult. Once I learned the store brand tastes fine, why go back?
Exactly. Why pay double? Management has outlined that comprehensive strategy to win back that shelf space through price pack architecture and heavy marketing, but executing that playbook guarantees a chaotic third quarter.
It's going to be messy. The 800 basis point tax headwind and the front-loaded SG&A expenses for the ERP system will likely result in a really ugly EPS print in Q3.
And algorithmic trading models and reactionary institutional money will likely punish the stock when those Q3 numbers hit the wire.
So that potential sell-off is precisely why you wait.
Which brings us to the actionable advice. Keep this stock on your watch list and treat the upcoming Q4 earnings report as the ultimate binary trigger.
A binary trigger. Explain that.
Management has drawn a literal line in the sand, promising sequential volume improvement that culminates in positive volume growth by the fourth quarter.
Right. They promise positive volume by Q4.
So when Q4 data is released, ignore the top-line revenue, ignore the inorganic growth from acquisitions, and ignore any tariff refunds. Focus exclusively on one metric, the volume number for the Americas consumer segment.
Okay. And if that specific volume number flips positive in Q4?
If it flips positive, it validates the entire turnaround strategy. It proves their price pack architecture successfully navigated retailer pushback. It proves their digital marketing resonated. And it proves the consumer accepted the new value proposition.
A positive volume print signals the turnaround is real and the stock becomes a strong buy.
Yes. Conversely, if volume remains negative in Q4, the thesis shatters.
It means the consumer has permanently rejected their pricing power.
It means the marketing capital they burned in Q3 was totally wasted, and the store brand substitution is secular, meaning permanent, not temporary.
So if they miss that Q4 volume target, you avoid the stock entirely.
Exactly. It is the absolute definition of a show-me story. Management has the cash flow and they have the strategic vision, but they must tangibly prove they can arrest the decline in their legacy retail business without permanently degrading their margin structure.
All eyes on Q4.
Yep.
Now, before we wrap up today, I want to leave the listener with a final provocative thought. I want to return to a concept we touched on earlier, a really fascinating psychological observation CEO Brendan Foley made regarding the modern shopper.
The affordable indulgences.
Yes. Despite actively cutting back, managing basket sizes, shifting to private label, and hunting for value, Foley noted that internal data shows consumers are still aggressively prioritizing what he called small indulgences.
specifically highlighting flavor exploration as a protected category in their shrinking budgets.
Right. It highlights this totally fascinating contradiction in consumer behavior. A shopper will gladly trade down to a cheap private label pasta to save $1, but they absolutely refuse to compromise on a premium finishing salt.
It seems irrational, right? But it actually maps perfectly onto a well-documented economic phenomenon known as the lipstick effect.
The lipstick effect. I love this concept.
It's classic economics. During periods of severe recession or prolonged inflation, consumers broadly abandon large-scale luxury purchases.
Right. They cancel European vacations, they delay buying a new car, and they significantly reduce expensive restaurant visits.
However, to combat the psychological depression of all that austerity, they systematically redirect a small portion of those savings toward affordable, premium micro-luxuries.
The high-end tube of lipstick.
Exactly. It provides a disproportionate psychological boost for a fraction of the cost of a vacation.
So the thesis here is that complex, premium flavor profiles have essentially become the new macroeconomic lipstick.
That is exactly the point to consider. Think about it. A family of 4 going to a mid-tier sit-down restaurant right now is easily a $100 or even a $150 expenditure.
Easily. It's crazy out there.
Facing that reality, the consumer chooses to stay home. They buy commoditized bulk proteins and store-brand starches to save money.
But the baseline meal of cheap chicken and generic rice is economically efficient, but incredibly dull. It's depressing.
But if they deploy $6 on a premium McCormick Mexican spice blend or an artisanal finishing sugar,
they completely transform the sensory experience of that cheap meal.
Exactly. They are essentially outsourcing the culinary experience of a restaurant into their own kitchen for pennies on the dollar. They are leveraging McCormick's millions in R&D to elevate their baseline groceries.
That is fascinating. So the provocative question to carry with you as you analyze the broader food sector is this. If consumers are systematically adopting this exact behavior abandoning restaurants to elevate cheap groceries with premium flavor systems, are B2B flavor houses and premium spice companies actually the ultimate stealth play for a prolonged inflationary economy?
That's the billion-dollar question. Are we miscategorizing these companies as victims of inflation when in reality, they provide the exact micro-luxury a cash-strapped consumer demands to survive the macro whack-a-mole?
It profoundly alters how you calculate the intrinsic value of a bottle of hot sauce.
It really does. It forces you to look at flavor not just as an ingredient, but as a primary driver of consumer psychology during an economic downturn.
It absolutely does. Well, that is a wrap for today. Thank you for joining us on this Talk Tickers Deep Dive. The corporate narratives are dense, and the macro environment is unforgiving right now, but the truth of the business is always waiting to be uncovered in the data.
Just got to look closely.
Keep questioning the headlines, dig into the mechanics of the balance sheet, and we will see you next time.